Nice to meet everybody. Thank you for joining us today. It's a wonderful day in New York City. My name's Clercq. Thank you for the wonderful introduction, Marty. As Marty mentioned, well, my background is actually in supply chain management. So my parents run a company, ChinaPerformanceGroup.com. This is really where I got introduced to the whole world of supply chain management. And after working in the family business for a while, I started my own merchandising business. So very standard stuff, buy for X, sell for Y. And I encountered this issue of financing inventory head on when our sales grew from 600,000 to $1 million of sales between the first year and the second year, and we just couldn't find inventory finance. And what we realized is that this is actually a problem that is common to every single product business that exists, right? Every single product business deals with this problem you see here on the screen, which is you have to pay to manufacture your goods months and months before you actually receive them, and you can start selling them. And then if you're selling to a group like Target or Costco or Walmart, you often even have payment terms. So it might be 60 days between production and shipping, plus another net 60, 90, or 120 to get paid after you deliver the goods. And this creates what we just call like the inventory cash flow pinch, right? You're always paying for it here, you get paid for it there. Meanwhile, your business is growing, and there's this ongoing capital constraint to your growth where you can only essentially finance the additional growth of your business as you scale it up. And what we've seen is that this is an industry that has been largely ossified. It hasn't changed very much, even though the underlying industry has changed, right? So what do you see today? Well, we've seen Shopify, we've seen Wix, we've seen WooCommerce, right? These abilities for product businesses to directly sell to their businesses. There's an increasing number of these in the market today, what we call essentially omni-channel distribution product businesses. And the traditional financing like AR factoring is great if all you're doing is selling to Walmart or Target, right? You've got that nice receivables, you can factor it. But increasingly, we're finding that those forms of financing are not meeting the needs of the market. And all the new distribution channels, right? Now I want to buy the stuff, I want to sell it directly. My margins are way better when I do that compared to when I sell it through Target or Walmart. So we're seeing that traditional funding is not really meeting the needs. And additionally, there is a very timely thing happening right now. We talked about how there's a decent amount of pessimism in the market. There's a massive liquidity crunch happening within regional banks, small banks, and other small and medium business lenders, where literally in the last 6 months, we have seen a significant uptick in demand from very, very high quality businesses that essentially got rug pulled by the lenders that they had been working with sometimes for years and years. But now, due to liquidity constraints, they need to find other forms of supplemental finance in order to continue to grow their business. So it's a very timely thing right now. We do feel like we're supporting a great number of the entrepreneurs that are underpinning really this economy. And one of the other things that I say is, the economy goes up, the economy goes down. You might see a shift in consumer behavior, maybe from premium goods to more economy level goods, right? But at the end of the day, guess what? People need to go to school, they need to feed their families, right? The ongoing flow of goods continues. And we are seeing that for the strong businesses that we work with, they still have very significant and ongoing consumer demand for their products. So that's the underlying asset, right? And what we've seen is that, I would say we are doing something new. We're a startup, right? We are not, we're doing something new here, but not that new, because inventory on consignment has existed. It's an extremely well-founded principle. So what are we doing? We have created an inventory asset marketplace where anybody can bring their business data to our asset exchange, and they can essentially post what we call a consignment opportunity, which is to say, hey, I've got great consumer demand for this widget, right? And if I could buy 10,000 widgets, I could sell them and I could earn a 60% margin. And I'm willing to pay an inventory consignment profit per month, right? Let's say it's a 6-month long term. I'll pay 1.5% a month or 2% a month of consignment profit on top of my cost of goods. So you fund the goods, you buy them for me, you own the goods. We file a UCC1 lien on every single lot of consignment inventory at Kickfurther. And when that inventory sells, you are the most senior secured creditor. It's different than a loan, right? Because you actually buy and own the goods, and the bankruptcy courts and other courts, we've seen this hold up, treat inventory consignment very, very differently. And I mentioned this isn't anything new, right? The consignment has existed in the UCC for hundreds of years. But what is new is the ability to bring a data-driven approach to inventory assets and make it available to the market that we're serving, which is typically now businesses that have between $5 to $10 million of trailing 12 months revenue. The smallest businesses we work with have about $500,000 of trailing 12 months revenue. The largest businesses are up in that $50 million range. So, excuse me?
What inventory will you not?
Give it a sample.
Oh, yeah. So we will fund pretty much all inventory other than regulated products. So we're not doing firearms, alcohol, tobacco, and like no ATF right now. And we are currently not doing frozen or refrigerated products due to the increased costs, like the logistics costs essentially. So I plan to expand into all of those areas as the marketplace scales up, but we have a massive opportunity in what I would call essentially consumer product goods, CPG right now.
You're doing the funding, but you said an exchange.
So Kickfurther, we manage the entire inventory consignment process. We file a UCC. The structure of the agreement is we are acting as a buying agent on behalf of the consignment buyers.
So you're not the owner, the buyers.
Correct, exactly. The underlying buyers have direct ownership. We act as their agent to file the
Once
UCC.
the buyer buys, does that mean there's an exchange with the secondary market where they sell part of their interest if they want, or they're waiting for the?
You're ahead of me. So secondary market's coming, right? We don't have a secondary market today. Right now, you buy the inventory, it's placed on consignment with a product business. And then as that product business essentially uses the inventory through whatever means, whether they sell it, give it as a sample, whatever else, however that inventory is decremented, it triggers the underlying consignment agreement, and we invoice ACH debit that business and then distribute the proceeds pro rata to the funders.
How do you overcome the risk that the manufacturer fails?
The manufacturer fails.
From the standpoint of, I think of it, no offense,
Of course.
it's like construction finance.
Mhm.
You build a big building, it's a construction loan. It may be cost overruns, it may not get finished.
Yeah. Well, I mean, I think anybody here that's been in the industry knows, right? But if you're in the situation where the building is failed, right, and like you have to liquidate the inventory, that's going to result in a loss for the funder. So
this is a product that might be partially completed.
we only fund finished consumer goods. So we buy directly from manufacturers. And one of the elements that factors into our risk model is the number of times a business has done a repeat production with that specific manufacturer.
The funding is only on completed inventory.
Yeah, consumer product goods, finished consumer product goods. But we will fund prior to manufacture, right? So one of the elements that goes into the risk model, like we've been doing this now for 9 years. And we've built out a pretty significant set of data. And my background in supply chain management, one of the things we've been focused on from the beginning is supply chain and manufacturing risk, because we're very aware that it's obviously one of the risks that is just, you can't really separate the manufacturing risk if you're funding inventory on consignment, right? So we try to measure that risk on the front end with the machine learning model that we've developed. Where was I? So as I mentioned, go ahead.
You take care of sales tax now that you're an owner?
So it's placed on consignment with the business. The business is expected to take care of the requisite sales taxes as the seller of record of the inventory.
So you don't need to get involved?
We don't get involved with the sales tax as it stands today. So what's the opportunity with Kickfurther today? As I mentioned, there's a ton of great businesses coming onto the platform. These inventory on consignment opportunities, the average duration is between 5 to 6 months long. You can think most of these businesses are turning their inventory 2, maybe 3 times a year. The amount of consignment profit they are offering is varied depending on the different risk tiers that we've generated through our machine learning model. So what we have here at 14% annualized consignment profit is essentially an XIRR measure with the assumption that you'll be able to you'll fund new inventory once you receive the payments back. Now, that 14% is the expected profit for the top tier, what we call pro, or you can think A quality deals that are currently paying about 1.2% consignment profit per month today to the inventory funders. And we're seeing that scales from at the top about 1.2%, and we're clearing deals at around 2.1%. And that's the market that we play in today. We're also seeing that it's largely uncorrelated. So as I mentioned, stock market goes down, stock market goes up and down. You got to buy stuff, right? The economy keeps going. People have to go back to school. So we are seeing that there's ongoing demand, and we're highly diversified. So we have today hundreds of product businesses doing inventory on consignment with us as their primary inventory funding source. We did $80 million of inventory last year. We should be on track to fund about $120 million of inventory in 2024. And in terms of highly diversified, we're doing between 60 to 75 consignment opportunities in any given month. So you can get diversified across about 200 different product businesses, different entrepreneurs in one quarter.
What's the credit profile of these entrepreneurs?
So we have our own internal Kickfurther risk model. We call it the Kickfurther metrics model. So that ingests all sorts of different credit profiles. I would say the average credit score is in the 700s, like low 700s credit score for the entrepreneur. We are staying like out of the subprime today. It feels like in the environment we're in, we've made a very conscious decision to move up the quality chain. As there's been a bit of a liquidity crunch, we've had the opportunity to move up and fund more resilient, more developed businesses. We've developed this risk model off of over 1,000 businesses and consignment opportunities on the platform.
How big are these companies typically?
So the average today is between $5 to $10 million of trailing 12 months revenue. The largest is about just south of $50 million. And then the smallest we'll do is $500,000 or up in terms of trailing 12 months revenue, to give you an idea. Our risk model is based off of our proprietary data. We've been doing this for 9 years. Marty, you mentioned Tim Draper invested. We also have other great investors like Bill Ty, Tom Golisano. So they've been very supportive and meaningful in helping us move this business forward. And this risk model is based off of both the internal risk metrics that we've been looking at. We mentioned the supply chain, manufacturing, distribution. That's all specific to physical goods. And then on top of that, we tap into what's called an open banking API that leverages all of the data from the SBA. So we look for, essentially, we layer financial resilience on top of good business management, and that creates a holistic, specific for inventory assets risk score. And that was deployed in March of this year. So last time I spoke here at New York City, we didn't have this live, I believe, or it was just coming out. And now, we have enough performance data on it that we see that it is risk ranking even better than we expected. So for those that know area under curve, our area under curve on the new Kickfurther metrics model is almost 75%. So we're very happy with where that metrics model is today.
Is there any collateral besides the merchandise guarantee?
So there's a personal guarantee on most of the consignments. There is a personal guarantee. And other than that, no, we do not take additional warrants. We don't take equity or anything like that. But there are essentially, to have inventory on consignment, to have those protections as true inventory on consignment, which the court then affords us, later on, it needs to be that the funders are taking the real inventory risk, right? So that's the underlying structure is that the funders own the inventory, and that's the obligation that the business has, is to pay for that inventory once it sells, according to the consignment agreement. There's multiple ways to participate on Kickfurther.
So if the inventory doesn't get paid for, it gets returned to you?
If the inventory doesn't get sold, the business has a right to return the inventory and cancel the underlying consignment agreement. That has a 10% restocking fee. So it's generally expensive to the business to do so. And we leverage our data to make sure, like I call it the lifeblood SKUs right? So we're not, if you've got like a sunglass company, right, and they want to get into sneakers, we're not funding the sneakers, right? We want to fund their sunglasses. So we're funding the core SKUs that we can see are driving the ongoing revenue of the business. And that frees up cash flow.
No product drift, right?
Yeah, exactly. Like I mean, it's just all of this that you learn from experience, right? We've been doing this for 9 years, and it's like, guess what? If you fund a sneaker company and they get into hats, the hats often don't do very well, right? So it's like you want to stay in your lane, and we want to fund the inventory that is quote unquote in the lane for the product
And
businesses.
what about the other creditors? Like, what kind of credit do these companies carry? Like, do they have, you know, lines of credit? They're like 20% credit to revenue, 50%? What?
So good question. So one of the funny things that came out as we were developing this whole risk model, one of the things we learned, there's 2 things that flag for risk: having zero debt. If you've gotten to the stage where you are and you have literally zero debt on your books, that is an indication that either we're not seeing everything because you're hiding the debt in some other bank account, right? Or you're not running your business very well, right? Because at the stage you're at, almost every single business we work with has SBA loans or something else, because it's just much cheaper capital, right? If you get an SBA loan at 12% APR, that is going to be cheaper finance than our inventory on consignment, right? So a little bit of debt between, I think I don't have the exact numbers here, but it's something like between 3 to 7% debt to revenue ratio, somewhere around there, is actually a positive risk flag. And then over, it gets more and more and more. And we do see businesses like with loan stacking, like merchant cash advance revenue stacking, you can see some of these guys get to ridiculous numbers, like 50%.
You have defaults.
Yes, we've been doing it for 9 years.
Payment is made. Where you have the flow of funds. Well, the second part of that is what kind of volume of defaults and what those ratios. When the payment is made, it goes to the owner.
Sorry.
What's the flow of funds when the
So in certain businesses, as a de-risking lever, we have cash tracking in place where we have a Kickfurther owned bank account, which is the central bank account for that depository. In most cases, the business is getting the payment directly and then remitting the payment to Kickfurther. And or actually, we're checking in and then we invoice them, and then we're tied into their bank with Plaid, and we ACH debit the payment as we see that the inventory is decremented.
that doesn't necessarily mean they actually follow up and make the payment, right? If they have cash flow.
Sure, yeah, we've had to develop, we have a whole servicing department. We do significant consignment servicing as well. So we have a whole servicing department. We've been doing this for 9 years. So it's absolutely something where you have to invoice, you have to debit. That like 90% of the time, the debit's just clear and it works pretty well. And then, yeah, third, we have like the same thing that anybody else has, which is like, 30, 60, 90-day waterfalls, and you're chasing it, right, up until the point that it gets placed with outside collections. Now, one of the benefits that we do have that other people don't is that we have the right to go to their clients and say, hey, Walmart, they just sold you our inventory. Here's the consignment agreement. Here's the UCC lien. Stop paying them and pay us. And if you keep paying them, you are aiding them in committing conversion because they are in default now, right? So we have additional rights that a merchant cash advance or an AR factor, well, depending on the terms of the factor, right? But we have additional rights as consignee creditors that other lenders do not have. And we leverage those rights in our servicing.
That fundamentally the same, the difference otherwise is the same as merchant cash advance.
Sorry?
Is it fundamentally the same as merchant cash advance, except you're saying that you have the right to have the flow directly from you?
So where we have cash trapping, what I would call it is a de-risking measure, but no, the underlying transaction of inventory on consignment, like we've gone through this in bankruptcy courts where Kickfurther is considered number one secured creditor. We get paid out in full in like 2 years because it's bankruptcy, right? And that sucks. But we see like a host of other merchant cash advance guys that are getting paid 11% in 5 years, right? So we have a white paper about the strength of consignment rights for the creditors because it is significantly stronger from a workout perspective than an unsecured merchant cash advance. We file a UCC1 lien on every single inventory consignment that we do. And this is one of those funny things because merchant cash advance, like I've been doing this since 2014, right? And in the ZERP environment, these merchant cash advance guys were just ripping. I would get emails and emails and emails. Hey, look, On Deck just grew from 250 in originations to 500 million, and now they're at $1 billion. Now they're at 2 billion, right? And I would always get these emails from our, other stakeholders. And the truth is, if you grow unsecured, right, and you're just tossing cash out into the market, you can grow a lot faster. we've been extremely disciplined with our growth, and we've done it in this way and incurred the costs of actually doing inventory on consignment since day one in 2014. And that means that we make our businesses jump through more hoops than just a merchant cash advance does, right? And that's been an ongoing conversation with my sales team where they're like, make it easier, make it easier. And it's like, no, we are doing something very different and special here. And I don't care what the current flavor of the month merchant cash advance guy is doing, because guess what? Just like as On Deck was up, On Deck came down, and Cabbage came up, and Cabbage came down. Today, it's Ampla. Ampla is all over the place. They're throwing money in the
Were you
market.
impacted by COVID at all?
Yeah, we were impacted by COVID. Pretty much the entire industry was impacted by COVID. So COVID did two things. It was rough for everybody. One, it tricked everybody into thinking that things were okay at the end of 2020, right? So almost everybody had great performance in 2020. Why? Because even businesses that were struggling along, dying on the vine, got a big fat check from Uncle Sam. And guess what? They used that to pay off loans, right? We saw our highest rates of early payments happened in 2020, more so than any other year that we have on the books, because Uncle Sam money came in. A lot of these businesses used it to clean up delinquent debts or just clean up their books because they were cash flow they suddenly had cash. So they're like, oh, great, let me pay off all this debt. And then a lot of those businesses end up failing. And then the next thing that happened was years later, you ended up, someone else mentioned here, supply glut, right? So it's like, look at the Peloton is the best case study, right? So it's like you had all these people, Peloton's like, oh my God, everybody's buying exercise bikes. Better ramp up our inventory for 2021, right? And then they ramped up, they had like 1 million bikes sitting in warehouses all over the place, right? Because why? Because the increase in demand had nothing to do with Peloton. It had to do with these big, crazy, like, hey, you're not allowed to leave your house, right? And Peloton, meanwhile, was like, oh, look how cool I am, right? Like, I'm going to keep growing, no problem. But that was the other thing that we saw happen. So for instance, sports goods, we have like a trampoline company that's been struggling since 2020. Same exact thing, right? Like ramped big in 2020 and then had challenges. Like sporting goods in particular, home sporting goods, a trampoline company. We have a scooter company that's still struggling to like pull themselves out. And then there was a bunch of people in the cleaning supply space, right? Disinfectants, masks, liners. That was especially terrible because you had no supply. You had a whole bunch of new entrants enter market, buy up a ton, right? And then you had a massive oversupply in the industry. Still to this day, there are lots of nitrile gloves, masks, gowns, right? That are going at liquidation inventory prices.
Wow. So, and who's your team? Do we have that here?
Who's my team? Yeah, so I've got Tisha, my CMO is right here with me. I'm the founder and CEO. The rest of the team includes, I don't think we have a slide on it, but my co-founder, my head of product, was my college roommate. We have a general counsel located out in Boulder, Colorado, also the general counsel for Denver Angels. I would say, who else? Scott McKay. I mean, like, I don't remember everybody's resumes off the top of my head, so I should have a slide for that. But we have an awesome team, let me tell you. I'm very happy with them.
Equity for the company, or you're raising consignment dollars?
So with the growth next year, 120 million, we expect we need another $20 million of liquidity allocated to the platform. So we're really raising consignment dollars here. We are right about to hit cash flow positive.
Is that 20 million for consignment?
For consignment, just for funding the inventory. So we're really here looking for participants to fund the underlying inventory. We've got a good growth rate coming next year. That being said, I don't know that we have a slide on this, but we are offering for allocations of 3 million or more, we're offering 1% matching on our last convertible note instrument, right? So the board authorized that through the end of Q1 for commitments of $3 million or more. Multiple ways to participate. You can just come on to Kickfurther, create an account. It's unbelievably easy, connect your Facebook and check some boxes, and you're pretty much ready to go. And you can start to pick individual consignments that you would like to participate in. We have 3 up on the platform today for about 1.2 million. We have deals launching, about 2 to 3 deals launching every single day. The other thing that we have is an allocation tool, which is what Marty was mentioning. If you want, I'm very happy to carve out 15 minutes or one of my team members to take you through that tool. And that tool essentially says, hey, I want to fund A's at 1.2%, and I want no more than 40% of my portfolio to be in the B's, right? So it's got like 12 to 15 criteria that funders can select to receive allocations dynamically from the platform over time that fit your desires, your needs.
So do you have like historical returns, are those historical returns that you have there
Yeah.
on that chart, or are those the returns like this year?
These are the historical returns for the Pro, Plus, and Select segments based on the 2018 to the 2021 training data. So this is based on over 1,000 deals. This is dollar weighted loss adjusted. Again, ACP is like an XIRR measure. So dollar weighted loss adjusted. And what's really weird about this is you'll see, like, why would the least risky, the pros, be paying the best returns? Because prior to the release of the machine learning model, we had a pass-fail model. So either you passed or you failed. And all of the people that passed were getting essentially the same rate on the marketplace, which means that the least risky deals are the ones that offered historically the best return. But now we're seeing that this has normalized to the way that you would expect to see it on a marketplace today with current performance data. We do not have a no, we don't have like a fund or something like that set up yet. But we would be open to that kind of participation. So I'm actually speaking with a gentleman this Friday that I met in Miami about setting up a fund potentially to participate on the platform. And then there's another group that's looking at that as well.
So this has a lot of synergy with Acorn Trade Finance, so if you want to interest, we definitely would like to.
Yeah, absolutely. I would love to have a
What's the
conversation.
last 2 years experience? I know you actually have the 3 years. What's the last 2 years been? Can you go back to that slide? There. So that's 20 to 2021. What's 22, 23?
So 2022 is like broadly rough. I think all alternative assets through the end of like 2021 and 2022 are rough. I think for us, we're going to just about break even once 2022 fully matures. And 2023 is looking really, really strong for us.
I'm talking about the return, these rates here.
Yeah, it's tough because it's like a 2-year maturity, full length maturity for this once you get to workouts and stuff. So we're not mature yet on 2023. My guess is that we're going to see about break even on 2023 portfolio wide. And then 2022 will be about break even. And then 2023, we're seeing, I think the target will be close to 15% through 2023.
Break even means no return.
Yeah, correct.
But principal is safe.
Yeah,
but no return.
Correct. Yeah, 2021 and 2022 were pretty bad across all alternative investments. Again, for those, there were some impacts like with the COVID and then the rug pulls and all of this and the increasing interest rate environment. Right, when liquidity becomes scarce, that just kind of creates a waterfall of of defaults. So,
any other questions?
Great stuff.
Awesome.
Great. Thanks so much.
Thank you, guys.